If you placed $100,000 into an index fund today, which one would actually increase your money more, Fidelity or Vanguard?
That is the $1,000,000 query we're examining today.
In this video, I'm going to demonstrate to you and the Money Explorer exactly what happens when you put $100,000 into Fidelity's index funds versus Vanguard's. We'll be reviewing real numbers, performance, dividends, fees, and how those all accumulate over time. Both providers present index funds in the same categories, which makes the matchup equitable. We'll compare their fees, S&P 500 funds, total market funds, and emerging markets. And at the end, you'll see which one across these categories could leave you with nearly $1.8 million more in your portfolio. But before we jump into the battles, let's quickly clear up what an index fund actually is. Because that's the foundation of everything we're about to explore. An index fund is basically a collection of stocks. Instead of picking individual companies and hoping you got it right, you invest in a wide range of companies all at once, so your risk is diversified. Most index funds follow specific benchmarks like the S&P 500 and try to replicate its performance. Because these funds don't need a team of managers constantly buying and selling stocks, the costs stay extremely low. You just set it, leave it, and let time do the heavy lifting. In fact, many financial icons, including Warren Buffett, endorse index funds for everyday investors who just want consistent, solid returns. So, the strategy makes sense, but the real question is who delivers better. Is it Fidelity or is it Vanguard? But which one helps you keep more of your returns? Let's see how the fees compare. Because even a small difference in costs can make a big impact on your overall gains. Even though index funds are known for being low cost, there are still variations between providers. And over time, those small differences can really accumulate. If you're investing for 20 or 30 years, even a 0.01% difference in annual costs can snowball into thousands of dollars lost.
Let's start with the basics.
Both Fidelity and Vanguard offer commission-free trading for stocks, ETFs, and most mutual funds. That's excellent news. It means you won't pay a fee just for buying or selling your fund. But there are still management fees or expense ratios which show the percentage of your investment that goes toward operating the fund. This is where things start to separate. Fidelity is known for pushing fees as low as possible. In fact, they surprise the market by offering some funds with zero expense ratios. One of their most popular FXAIX, their S&P 500 index fund, has an expense ratio of just 0.02%. That's remarkably low. Vanguard's VFIAX S&P 500 index fund is also one of the cheapest funds on the market at 0.04%, but still slightly more expensive. While it's a difference of just a few bucks on a $100,000 investment, $15 versus $40, the longer you invest, the more it matters. Multiply that by years, compounding growth and portfolio size, and the savings pile up. Then there are the account-level fees. Vanguard charges a $25 annual fee on brokerage and IRA accounts unless you opt into paperless statements or have over $5 million invested. Fidelity, absolutely no account fees, not even for IRAs or smaller balances. And when it comes to trading extras like options and bonds, Fidelity comes out cheaper again. Vanguard charges $1 per options contract while Fidelity charges 65 cents. Both firms charge $1 per bond for secondary market trades, but compared to Vanguard's $25, Fidelity adds a $19.95 broker-assisted fee. So, when it comes to costs alone, Fidelity wins this round. Their rock-bottom fund expenses, no account maintenance charges, and lower trading fees make them ideal for fee-conscious investors who want to maximize every dollar. So now that we've got the fees out of the way, let's see what really matters. How much each fund can actually grow your money. Starting with the benchmark S&P 500. This index tracks 500 of the largest and most profitable U.S. companies, including names you definitely know: Apple, Amazon, Microsoft, Google, and more. If you want a simple set-it-and-forget-it way to invest in America's biggest businesses, this is it. Historically, the S&P 500 has delivered about 10% average annual returns. And over the past 15 years, that number has climbed even higher, up to 12.6% per year. That's a strong track record. Both Fidelity and Vanguard offer extremely affordable funds that follow this exact index. For Fidelity, it's FXAIX or the Fidelity 500 Index Fund. For Vanguard, it's VFIAX or the Vanguard 500 Index Fund, Admiral shares. Both funds are built to replicate the same set of companies, and on the surface, they seem nearly identical. But once we dig into the actual results, small differences begin to show. So, how do I compare them? I put them in my forecaster calculator, which uses these metrics from funds to tell me how much I should expect from a fund. $100,000 investment, dividend yield, average annual return, dividend CAGR. Let's look at the key metrics that drive their performance. Fidelity's FXAIX has a forward dividend yield of about 1.16% with dividend growth around 7.01% and annual share price appreciation averaging 13.04%. Vanguard's VFIAX matches the same dividend yield at 1.16%, but its dividend growth is slightly lower at 5.8%, while share price appreciation comes in a little higher at 13.21%. Now, what happens when the money explorer invests $100,000 and just lets it sit? Fidelity's FXAIX adds a total value of about $4,462,935, including stock growth and reinvested dividends. Vanguard's VFIAX ends up close but slightly higher at $4,582,491. That roughly $119,000 gap may not seem like a deal-breaker in the long run, but it matters. Even small efficiencies add up when you're talking about six-figure investments over decades. So, in this round, Vanguard takes the win, tying up our scoreboard at 1 apiece. But the S&P 500 isn't the whole story. What if you want exposure to everything in the US market from large caps to small startups? In the end, I'll show you which one across the 5 categories could leave you with more than $1.8 million extra in your portfolio. Let's find out who performs better in that next round, the Total Market Index Showdown. This type of fund isn't just about the 500 biggest companies. It's designed to include thousands of US companies, from the giants like Apple and Tesla to smaller and mid-size firms with high growth potential. It gives you the full snapshot of the US economy in one investment. Think of it like zooming out to see the entire landscape, not just the skyline. Fidelity and Vanguard both offer top-tier total market index funds. Fidelity's version is FSKAX, the Fidelity Total Market Index Fund. Vanguard offers VTSAX, the Vanguard Total Stock Market Index Fund, Admiral shares. Both track a broad U.S. market index and include around 3,500 to 4,000 publicly traded companies covering nearly the entire investable stock market. Here's how they compare on the numbers. Fidelity's FSKAX has a forward dividend yield of about 0.99%, with dividend growth around 5.35% and annual share price appreciation of about 12.05%. Vanguard's VTSAX comes in slightly stronger on yield at 1.16%, dividend growth around 5.82% and 12.22% average share price appreciation. So, how do they stack up when we put $100,000 into each? Let's start with Vanguard's VTSAX. Over 30 years, it would add a total value of $3,551,120 to your $100,000 investment. An impressive figure that includes capital appreciation and reinvested dividends. Fidelity's FSKAX would come in a little lower with a total value of $3,306,830. That's a solid return too, but still about $245,000 less than Vanguard's performance over the same period. It's worth noting that their holdings are nearly identical. Both funds include the same major companies and follow similar allocation strategies. So, what's driving the gap? It likely comes down to slight variations in fund structure, dividend reinvestment timing, and tracking precision. Vanguard's long-term indexing focus seems to have given it the edge here. So, this round also goes to Vanguard, which brings the scoreboard to Fidelity 1, Vanguard 2. Let's see who claims the lead in our next round as we head into the high volatility, high reward zone of emerging markets. Emerging markets are nations undergoing rapid economic expansion and industrial development like China, India, Brazil, and South Africa. Investing here involves greater unpredictability, but also the possibility of substantial gains over time. Both Vanguard and Fidelity provide funds focusing on this category. Vanguard's choice is VEXAX, the Vanguard Emerging Market Stock Index Fund, Admiral Shares. Fidelity responds with FBADX, the Fidelity Emerging Markets Index Fund. Vanguard's VEXAX has a forward dividend yield of about 2.22%, dividend growth of nearly 6.25%, and average share price increase of 4.63%. Fidelity's FBADX appears slightly stronger overall, with a dividend yield of 2.32%, dividend growth of 7.18%, and share price appreciation of 4.98%. So what happens when the Money Explorer invests $100,000 into each? Vanguard's VEXAX grows to about $765,535 over the long term. Fidelity's FBADX performs better, ending at roughly $968,349. That's a difference of more than $200,000 in Fidelity's favor. The reason may come down to superior fund structure, cost efficiency, or timing of reinvestments. But in the end, FBADX dominates the emerging markets round. That raises the scoreboard to Fidelity 2, Vanguard 3. After 4 rounds, here's the situation. Fidelity prevails on fees and in emerging markets. Vanguard claims victory in the S&P 500, the total market. This puts the scoreboard at Fidelity 2, Vanguard 3. But the real narrative comes from the numbers themselves. Let's break it down. In the S&P 500, Vanguard outperformed Fidelity by about $119,556 over 30 years. In the total market comparison, Vanguard surpassed Fidelity by another $244,391. Fidelity did push back in emerging markets, with FBADX finishing about $22,814 ahead of Vanguard's VEXAX. And in the fee contest, Fidelity saves a bit more each year, which accumulates over decades, but not nearly enough to offset Vanguard's dominance in the core funds. So, when you total it all up, Vanguard leaves you with about $2.35 million more across its 2 major wins. Subtract Fidelity's $22,814 advantage in emerging markets, and Vanguard still comes out ahead by nearly $1.8 million overall. And that's why the final winner here is Vanguard. If you're a long-term investor aiming for the strongest overall results, Vanguard index funds deliver greater value where it matters most. Fidelity is still a solid choice, particularly if you want to minimize fees or seek better emerging market exposure. But the heavyweight champion in this contest is Vanguard. Not everyone has $100,000 to begin with, but there's a solution. Click the video on screen to discover how to make $7,000 per month with only $20 a week. If you enjoyed this video, hit like, subscribe, and share to support the Money Explorer for more smart money insights.